Good morning and welcome to TOITOI Japan Market Radio. I'm your host coming to you from Tokyo on this Wednesday, March 25, 2026. For those of you tuning in for the first time, this show is designed for global investors who track Japan or hold Japan exposure in their portfolios. Today we're covering the latest on Japanese equities, the yen, and what's driving sentiment across Tokyo markets. Let me bring in our portfolio manager who focuses on Japan macro. Could you walk us through what happened in today's session?
Thanks for having me. We saw a fairly strong rally across Japanese equities today. The Nikkei 225 closed at 53,749.621, up 2.866%, while the TOPIX gained 2.485% to finish at 3836.0. Broader risk appetite was also evident, with the Mothers Index jumping 3.592% to 2394.0. Japanese rights were more muted, adding just 0.722% to close at 1952.0. On the currency side, dollar-yen moved to 158.978, up 0.315%, so a modest weakening in the yen. Commodities were mixed, with gold in yen terms rallying 3.843% to 17,160.0, while crude oil dropped sharply by 4.126% to 88.54. The common thread here is a clear shift in risk sentiment tied to developments in the Middle East.
That's a significant move in crude, and it seems to be at the center of today's story. Let's dig into that. One headline catching attention is about the Nikkei's rebound facing headwinds from Iran-related risks and the potential for an oil shock. What's the concern here?
Right, so while we did see the index rebound today, there's a real structural vulnerability that investors need to keep in mind. Japan imports nearly all of its energy, and a significant portion of that comes from the Middle East. Any escalation in geopolitical tensions around Iran or disruptions to supply routes directly threatens Japan's energy costs. For context, higher oil prices hit corporate margins hard, especially in transportation, logistics, and manufacturing sectors. It also feeds into inflation dynamics, which complicates the Bank of Japan's policy calculus. So even though we saw strength today, the upside for Japanese equities is somewhat capped by these external risks.
And in terms of market impact, how would a sustained oil shock play out across asset classes here?
Let's break it down. On equities, a sharp rally in oil would likely weigh on the Nikkei and TOPIX, particularly energy-intensive exporters and transportation stocks. You'd probably see rotation into more defensive areas like utilities and consumer staples. For the yen, it's a bit more nuanced. In the immediate term, escalating geopolitical risk would likely strengthen the yen as a safe haven asset. But over time, higher energy import costs create deflationary pressures and widen the trade deficit, which can weaken the currency. On the rate side, if risk aversion intensifies, Japanese government bond yields would likely stay anchored or even decline as investors seek safety. However, if oil-driven inflation becomes persistent, that could eventually push yields higher and force the BOJ to reconsider its accommodative stance. So it's a dynamic that cuts both ways depending on the duration and severity of the shock.
Understood. Now, flipping to the other side of the story, we also saw reports emphasizing that the Nikkei jumped as oil prices dropped and fears eased. There seems to be some optimism around de-escalation signals from the Middle East. How do you read that?
Yes, that's the catalyst behind today's rally. There were emerging signals suggesting a potential cooling of tensions in the region, and markets responded quickly. For Japan, this matters on multiple fronts. First, energy security improves when the Middle East stabilizes, which supports more predictable pricing and supply chains for crude and LNG. Second, global risk sentiment tends to improve in a de-escalation scenario, and that benefits cyclical Japanese equities, particularly autos, materials, and industrials. Third, calmer conditions reduce the risk of disruptions to critical maritime trade routes like the Strait of Hormuz, which is vital for Japan's import and export flows. All of this creates a classic risk-on environment.
And that risk-on tone is clearly visible in today's price action. What about the yen and JGB yields in this scenario?
Exactly. When risk appetite improves, safe haven demand for the yen tends to decline, and we saw that today with dollar-yen pushing slightly higher. Investors are rotating out of defensive assets and into riskier positions, which weighs on the yen. On JGBs, yields edged modestly higher as global sentiment improved and flight to safety demand eased. That said, the primary driver of Japanese yields remains BOJ policy rather than external risk sentiment. As long as the BOJ maintains its accommodative stance, yields are unlikely to move dramatically even in a risk-on environment. But the direction is clear: modest upward pressure as sentiment stabilizes.
Staying with the energy theme, another angle being discussed is how the drop in crude oil specifically supports Japanese equities. Japan's dependence on energy imports is well known, so lower oil prices should be a structural positive, right?
Absolutely. Japan imports roughly 90% of its crude oil, so any decline in prices directly reduces the import bill and eases inflationary pressures. This is particularly important for companies with thin margins or high energy intensity. Lower input costs mean margin expansion for utilities, transportation firms, and manufacturers. It also reduces the risk of stagflation, which has been a concern in recent quarters. That's why you saw broad-based strength across the Nikkei and TOPIX today. Energy-intensive exporters and consumer discretionary names are likely to benefit the most from this dynamic.
And what does this mean for BOJ policy expectations? Does lower oil change the calculus around rate hikes?
It does, but the effect is somewhat mixed. On one hand, lower oil prices reduce near-term inflation concerns, which could lessen the urgency for the BOJ to tighten policy. That's yen negative in the short run because it keeps the policy rate gap wide versus the Fed. On the other hand, sustained lower commodity prices improve Japan's longer-term fiscal position and reduce import inflation risk, which is yen positive structurally. For JGB yields, the takeaway is that inflation expectations moderate, which likely keeps yields stable to slightly lower. The BOJ would have less pressure to tighten aggressively, so yields stay contained. The key is how persistent this oil decline proves to be.
So we're seeing two competing narratives today. On one side, a rebound supported by falling oil and Middle East de-escalation. On the other, lingering risks that could cap upside if tensions re-escalate. How should global investors positioned in Japan think about this?
I think the right framework is to recognize that today's rally is constructive but fragile. The drop in oil and de-escalation signals are genuine positives, especially for Japan given its energy dependence. But the structural vulnerability remains. If geopolitical conditions deteriorate again, Japan is more exposed than most developed markets due to its reliance on Middle Eastern energy. From a positioning standpoint, this environment favors a barbell approach. You want exposure to cyclical sectors that benefit from lower energy costs and improved risk sentiment, like autos and industrials. At the same time, maintaining some defensive exposure in utilities or staples makes sense given the tail risk. On the currency side, a weaker yen supports exporters, but that also depends on the BOJ's reaction function if inflation dynamics shift.
That's a clear roadmap. And just to tie it all together, we saw gold in yen terms rally quite sharply today, up 3.843%. Is that a hedge against residual geopolitical risk, or something else?
It's likely a combination. Gold in yen terms benefits both from global safe haven demand and yen weakness. Even though risk sentiment improved, there's still uncertainty around whether the de-escalation holds. Investors are hedging that tail risk with gold. Additionally, the modest weakening in the yen today means gold priced in yen terms gets a boost mechanically. So it's both a geopolitical hedge and a currency effect. It's worth watching because if tensions flare again, gold could extend gains further.
Understood. Let's wrap up today's discussion. For global investors tracking Japan, the key theme today was a risk-on rally driven by falling oil prices and signs of Middle East de-escalation. Japanese equities responded positively, with the Nikkei and TOPIX both posting solid gains. But the recovery remains vulnerable to external shocks, particularly around energy supply and geopolitical stability. The yen weakened modestly, and JGB yields stayed relatively stable as BOJ policy remains the dominant anchor. Any final thoughts for listeners?
Just to emphasize that Japan's market sensitivity to energy prices and Middle East developments is not going away. This is a structural feature investors need to monitor closely. Today's move is encouraging, but staying nimble and diversified across sectors is prudent given the external risks. Keep an eye on oil, yen dynamics, and any BOJ commentary in the coming sessions.